Welcome to MK Crypto Diaries. I am your host, Dr. Justine Scerri Herrera, and we are pre-recording today's episode on the 21st of February 2023. This episode marks the second episode of the miniseries we are launching on MiCA, the DLT pilot regime, and CAF. Today, the miniseries episode is all about the composability of stablecoins, how they are different from electronic money issued by electronic money institutions as we know them, and how stablecoins will be treated under MiCA. We will also be discussing the potential negative effects which may arise due to the restrictive nature of some of the provisions found in the MiCA regulation. To discuss this topic with us on today's episode, we are extremely excited to announce that we have a very esteemed guest, Aleksi Grym. Aleksi Grym is the head of Fintech at the Bank of Finland and has been for the last 6 years. Aleksi has 2 decades of experience in finance, strategy, economics, and policy work. So Aleksi, thank you so much for joining us to be a part of this amazing discussion we are going to have, focused on MiCA and more specifically on stablecoins, composability, e-money, and more. I'm very excited to get into this discussion with you. I'd like to open a bit lightly and perhaps ask you to give us a definition of e-money, so under EMD2, just for the benefit of the listener, and perhaps also a couple of examples of prominent, popular, known e-money institutions or issuers.
Okay. Yeah. Hello. It's a pleasure to be here. Definitely a light question. Electronic money, as per the directive, I think the definition is actually quite good in EMD2. So I think the keyword there is stored monetary value, first of all. And if we think about historically, that's really what some of the first e-money products were. They were prepaid cards, or you actually stored monetary value on a card. But then the issuers noticed that that's not necessarily technically the best way to do it. So there is an addition in the definition that says a claim on the issuer. That's really important. So nowadays, e-money very rarely, if ever, is actually stored on any device. It's actually just a claim on the issuer.
Yeah.
And then another very key element is issued on receipt of funds. That's really, really important. So the issuer can't issue e-money unless they actually receive funds from the customer. Mm-hmm. And then it's for the purpose of making payments. And it should be accepted by someone else apart from the issuer. Otherwise, it's just a pre-sale of mm-hmm. the issuer's own products. So if you can use it somewhere else in another business, then it's e-money according to the definition.
Perfect. Amazing. Thank you. And under MiCA, we have to just move to MiCA. One of the 3 token classifications is EMT, so e-money token, which MiCA defines as the same definition it gives to e-money under EMD, which is the e-money directive. So MiCA states that EMT issuers would need to obtain the same license that EMI license holders, so traditional players, obtain. So anyone offering EMT tokens will need to apply for this EMI license. I came across a very interesting Twitter conversation of yours, which stemmed from a tweet back in 2021, titled, "Is there any difference between stablecoins and e-money?" which I found to be a very, very insightful conversation. And I didn't come across many similar discussions. So I'd really like to ask you if you could explain the differences you outlined in that Twitter conversation between e-money and stablecoins, and specifically those centering around composability, issuer hosting versus third-party wallets, and the network effects.
Yeah, that was definitely an interesting conversation, and I got some insights from some of the comments. So probably the one key insight was highlighting the difference in thinking. Maybe if we think about stable coins versus e-money, is that if I get e-money for myself, I practically have to enter into a contractual relationship with the issuer. So let's say there's an e-money institution and I want to have their e-money, then I practically become their customer, and then I can use it for payments. And I can't really hand over the e-money that I have to someone else unless they also have a customer relationship with the same issuer. So let's take a very practical example. If we both take a payment app, let's say Revolut or TransferWise or something like that, we both download the app, we both become customer of the issuer, and then we can transfer e-money between each other. Whereas if you have a stable coin, then technically you can transfer it to someone else without that other party being a customer of the issuer.
Exactly.
So they can custody, that they can hold the stable coin without basically the issuer knowing about it or becoming having a contractual relationship. So that's maybe the key difference that is usually pointed out when asked what the difference is between e-money and stable coins. But then I would like to point out that that's the same. Well, that it was actually possible for e-money also, at least originally, to be handed over to someone else in the same way. So basically, when it was a prepaid card, if it's stored value on a device, I can just hand you over the card or the device, and you don't have a contractual relationship with the issuer. So in that sense, there's not much difference between the concepts, and that's what I really wanted to highlight in that tweet.
Okay.
And I think it also showed in the MiCA regulation in the sense that they initially maybe started drafting out e-money tokens, and then they noticed, well, this is actually almost the same as e-money, so you have to get a license for that. So it's really difficult to actually understand if there's any difference between the two.
Yes. I think also one of the main differences, which you touched upon as well just now, is network effect. So once you can control the supply of EMT or stable coins, but once they're out in the open, any third party can use and create any products around those tokens, which is quite a new concept in the space of crypto. So lending and borrowing, wrapping as collateral, sending to non-custodial wallets, not tracking and tracing. So sort of completely out in the wild.
Yeah, that's true. So that comes from the technology usually used for stable coins. In that you can build different products, and the more, as you said, the more composable in that sense. You can combine it with other features and other products. E-money, I mean, there's no reason why you couldn't do that with any e-money product. You could have an API, for example, for your e-money product, but that usually you don't see that. It's more common in the kind of stable coin or crypto world.
True. And moving on, but keeping to MiCA. So MiCA classifies tokens in 3 categories. The first is utility tokens, which regulators don't seem to be so concerned with. And in fact, they're quite lightly regulated. Just a white paper in line with some requirements, and you notify the regulator. So there's no approval or licensing there. The second one is EMT tokens, which we just described, and basically it's getting a license under an EMI license. And then the third category is a sort of new category, which was created just to, I guess, regulate all the other stable coins which aren't e-money. And these are called asset reference tokens. Could you give an explanation of what ART's asset reference tokens are under MiCA, and maybe give some examples of current stable coins which are being widely adopted and used in the market and would be classified as an ART under MiCA?
Yeah, I mean, I think the asset reference token thing in MiCA is a little bit of a mystery to me. I can't actually point to any real life example straight away.
I think maybe USDC, because basically, even if it's backed by fiat, so which is not euro, so let's say USDC, which is just dollar backed, would probably classify as an asset reference token, because I would say, like, by elimination, it's any token which derives its stability from something, from assets, regardless if it's fiat, commodities, a mix, but not euro. So like any stable coin which is not euro backed probably would by elimination. But that's my interpretation.
Yeah, no, I think you're right. I think that's the idea behind it. And it does say in MiCA, it says that it's not an e-money token. So it's something that does not classify as an e-money token. It's something else, first of all. So you don't have the usual qualifications of an e-money token, for example, only issued on receipt of funds, needs to be sort of redeemable and so on. And then there is this idea of having stability, or that some assets are kind of trying to make sure that it retains some value. But then it doesn't really specify how it does that. Like, what's the mechanism of achieving that stability? It just says it references assets, but it doesn't say, do I have a claim on those assets? Can I redeem those assets? Like, can I actually redeem the assets themselves? Like, can I redeem? It talks about commodities or foreign currencies or something like.
It's true. How can you sort of, if it's a basket, it's hard to, say it's redeemable.
Yeah, do I get like 2 units of commodities and 3 units of foreign currency? Like, how does that work with a basket?
It's true.
It kind of implies that having all these assets gives it stability, but it doesn't really specify the mechanism how that stability is achieved, and that makes it a little bit mysterious to me.
No, I agree.
In that sense, yeah.
Maybe it will be addressed in the RTSs, which everyone's waiting for, and seems like they're going to be released after MiCA, which isn't the most efficient, but could be addressed there. And so if currently pre-MiCA, so before it enters into force, an issuer is offering and marketing their e-money token or their asset reference token, so it could be USDC, USDT, or any other token, and also has their stablecoin listed on trading venues operating in the EU, what are the time frames that these issuers have to apply and get authorized? So if you're already present in the market and then MiCA comes into force, are you aware of any time frames which the issuers have to comply with in order to get? Is it immediately, or do they have like a period?
So I don't know for sure. I've heard different versions of that. I think some of the rules will apply immediately, and some over a transitional period, and that transitional period could take as long as 18 months, I think.
Yes.
I remember hearing somewhere, and this is second, I mean, I can't be exactly sure, but I think some of the e-money related stuff would be maybe immediate or sooner, and then some of the other stuff a little bit later.
Yes, exactly. That's what I heard as well. E-money, you have to apply straight away, and asset reference, I think you have the transition period, and probably for the reasons that you mentioned before, that it's so complex to understand, it might take a bit longer for all parties to get authorized and understand the business models.
Yeah.
And from my understanding, if an e-money token or an asset reference token is not authorized under MiCA within these stipulated timeframes, whatever they are, if it's immediately or 12 months, they will not be able to be marketed, offered, or listed in Europe. Would you agree with this in terms of the availability on the market? And also, to your knowledge, do you think that there are any exemptions which apply in terms of size or type of investors?
So my understanding is the same, that in terms of arts, I think there needs to be a white paper approved by a competent authority. The only exemption I can think of is that if you already have a license, let's say you already have a credit institution license, then it might not be necessary for you to apply for another license. Then it's enough if you comply with some of the requirements, like a white paper.
Think if you have a license already, you have a bit of a competitive edge. I wonder if we'll see e-money tokens or credit institutions already licensed launching these asset reference tokens or stable coins and leveraging their licenses. Do you have any plans at the Bank of Finland, like not CBDCs, but any like private innovative issuances?
Well, we're the regulator, so we wouldn't be we would be giving the licenses, but yeah. We're definitely we're in the CBDC project of the Eurosystem, but that's another story. That's unrelated really to MiCA. Yeah.
All right. Okay. Great. And now MiCA focuses a lot on the composition of reserve assets, where and how the reserve assets are invested. And when it comes to e-money tokens, EMD states that issuers must only invest reserve assets in low risk liquid assets, which I believe essentially mostly comprise of government bonds, but then perhaps you can clarify. And then in relation to arts, in recital 30 of the version of MiCA being circulated, dated 5th October 2022, it states that to protect holders of asset reference tokens against the decrease in value of the assets backing the value of the tokens, issuers of arts should invest the reserve asset in low risk secure assets with minimal market concentration and credit risk. So here there is like some indicators of what can be, reinvested in terms of reserve assets. For e-money tokens, it's the same as EMD basically. And for arts, it says that they have to be secure, low risk assets with minimal markets and credit risk. So it's a bit of a generic statement. It's not really defined. What do you think in terms of the EMTs? So this probably you'll be able to answer with certainty. Is low risk liquid assets just government bonds, or does it comprise of other assets?
Yeah, so I think EMD is quite specific about that. There's actually, it quite specifically says what type of assets qualifies so-called secure and low risk assets. And I think it could be government bonds, other public sector debt instruments also qualify, I think. So those types of assets, those types of debt securities, essentially, could be an international organization, could be a development bank or something like that. But practically, we're talking about government bonds.
Okay.
It's interesting that MiCA, on the other hand, it seems to be more strict, because if you think about EMD, it says two words: secure and low risk. But MiCA says secure, low risk, but also with minimal market concentration and credit risk.
Yes.
So that would imply that it's actually more strict. It's actually more limited. But it doesn't have as specific, as far as I know, I haven't seen as specific kind of instructions on what those assets might be as an EMD, where it specifically says it's basically government debt instruments.
Hopefully the same thing, these RTSs will hopefully address them, because there's a lot of token stablecoins which would be classified as asset reference tokens. And I keep mentioning USDC, USDT, because 95% of the market cap of stablecoins in the market is BUSD, USDC, USDT. I think Euro-backed is like 1 or 2. So they're about 3 to 5% in terms of market cap. So obviously, if these stablecoins cannot be listed and don't get authorized under MiCA, they won't be able to be listed and traded. So there might be some market disruption over there. But then again, this is a bit of a limiting factor, because if USDC, USDT, which are already in circulation, already have their business models set up, and here you're limiting that the reinvestment of the reserve assets has to be not only low risk liquid assets, but as you mentioned, also focusing on narrowing down these risks further, it's going to be really restrictive and not very attractive for certain players.
Yeah.
So,
and if we think about that's interesting. If we think about the history of also EMD, I think the original idea was that, as the definition of electronic money in EMD says, you take funds from the customer and then they can get it back if they want. And in the meantime, you safeguard it. You basically put it in a bank account.
Yeah.
And it doesn't change into another asset. It stays as money. Like you take the money from the customer and then you safeguard the money, and then at some point you give it back. So what about the case where it's not an EMT, or it's not electronic money, but you have these different types of assets? Does it mean that you give back those different types of assets? And I think in EMD historically, it wasn't originally intended that you could invest the customer funds into, let's say, government bonds, but it turned out that otherwise it's really bad business. Like, if interest rates are zero, then it's not a good business anyway. But just taking the customer funds and safeguarding them involves cost. And if you how are you going to make money as an e-money issuer unless you can invest the funds?
Of course. Well, there should be maybe some ratios, like 70% low risk liquid, and then maybe 30% like high risk, something a bit, more attractive or something like that, which is still safeguarding because you have to be completely insolvent. But
exactly, that's why I think they added those additional possibilities into EMD, and I think maybe here we see the same thing. The issuers are going to say, well, it's not a good business unless we can actually invest them somewhere, and then it broadens the possibilities of where you can actually invest them.
Of course, because you can't even charge the token holders as well.
Right. Yeah.
So,
but then comes the question of at what point do you turn into a credit institution, into a bank? It becomes a bit of a gray area. Like you have credit institutions on the one hand, you have e-money issuers on the other hand, and maybe arts are somewhere in between them.
Yes. No, they're trying to put everything in the same box just because that's what they know, and it's hard to come up with a new framework for new assets which have such similarities to current assets. So they're sort of more trying to tailor and tweak their business models to fit the regulations instead of change the regulations to entertain these new assets. That's sort of how I saw things playing out.
Yeah.
And if I had to just stick to MiCA and arts and EMTs, and mention that there's a part which states that assets can be stamped and called significant assets. So I'm just going to quote a piece from MiCA where it says that the EBA shall classify arts as significant arts on the following criteria. So if at least 3 of the following are met, they will be considered as significant. So one is the number of holders of the arts is larger than 10 million. Second is market cap is higher than 5 million. 5 billion, they should be, not 5 million. The third is the number of value of transactions is higher than 500,000 transactions or 500 million per day. Another one is the issuer of the art is a provider of a core platform serviced as a designated as a gatekeeper in line with the Digital Markets Act. So I'm guessing one of the big 4 companies, it could be Google, Amazon. The scale of use of the arts for payments and remittances, the interconnectedness with the financial system, and if the same legal person issues at least one additional art or EMT and also provides at least one virtual asset service provider function. So if it's an exchange issuing more than one stablecoin. So these are the criteria which mention that if an issuer hits 3 of the 6, you're deemed significant. And then you have a significant additional burdens and regulatory hurdles, so additional risk and liquidity obligations, increased capital, own funds requirements, and also direct supervision from the EBA instead of the competent authority. Furthermore, MiCA is full of sweeping statements saying that if monetary policy is threatened, arts or EMTs can be forced to wind down or their license could be withdrawn. So I have a couple of questions focusing on this passage and these points. The first, do you agree with the sentiments of the EU legislators, and what are your thoughts on these restrictions, like maybe the reasons why they were put there, and if you agree with them?
So, I mean, it looks like the model for that, it's similar than what you see in banking regulation or banking supervision, is that if you have a significant bank, then you need a bigger supervisor, bigger competent authority. So I think that's one element definitely that you can see here is that if you become really big, then maybe a national supervisor isn't strong enough as a supervisor, so you need more muscle in terms of supervision, which is fine. I think that's sort of totally fair. And anyways, I think it goes both ways. I mean, you can see it in a way that larger or bigger or more significant players need stricter rules or more supervision, but you can also view it the other way around and say that the rules are lighter and supervision is lighter for some of the smaller players, which is fair towards them. You don't actually need to be as heavily regulated if you're a small player. So in that sense, I think it goes both ways, and it's really, I think, probably best for both supervisors and supervised entities that you have this 2-tier kind of rules for supervision and rules.
Okay, great. I understand. And what does the regulation mean by if a stable coin gets too big for monetary policy to be threatened? Like, what is too big, and what would trigger these extreme measures of forced winding down and forced redemptions to contain size? Is the EBA just preventing sort of Libra 2.0, which is the raison d'etre why MiCA started to be drafted in the first place? Or do you think sort of it's quite unlikely that these requirements or conditions will be triggered?
So again, I don't know exactly the background, but it sounds like the concern here is that a lot of funds would flow from bank deposits into some of these crypto assets. And as you said, it would have to, this is an extreme scenario, and they probably just wanted to have that backdoor in the regulation that in case something becomes really massively big, then we have a possibility.
You have the power to do it.
Yeah, exactly. Kind of, it's already kind of anticipated that we can then wind down one of these. But in terms of, I mean, we would have to be talking about absolutely massive scale.
For sure.
Yeah.
For sure, because to some degree it is quite anti-competitive. That sort of regulate additional burdens, capital, but then to force winding down is a very anti-competitive spirit. Obviously, I understand the interest of the ECB and the EBA and protecting the Eurozone, but then just from like a another perspective of, let's say, open free markets and innovation and competition, it sort of doesn't look good when you read them within the law.
Yeah, of course. Yeah, I think this probably refers to kind of extreme crisis scenarios. And it also sounds like a sort of typical financial stability concern.
Yeah.
It might, if I remember correctly, that it actually talks about, it's just not just monetary policy. It also mentions financial stability. So it would indicate that the concern really is that deposits are flowing out of it. It's basically causing a bank run in traditional banks. A lot of funds move out of bank deposits into these, and then the concern isn't so much what let's say the stable coins or the crypto part does. It's more about it's going to break our banking sector, and that's why that's not something we want to happen.
Fair enough.
So that's why we have that in there.
No, fair enough. And just as a last question, which would tie all this up together. So stablecoin issuers such as USDC, which is a very used, widely adopted stablecoin in the market, are intended for global usage. So it could be payments or remittance or trading or whatever it is, but on a global scale. So even though they could be offered and listed and marketed in Europe, the intention is for them to be a global stablecoin. Do you think that these restrictions and limitations, which I've described in terms of limiting size, would put off these large global players in the market, such as Circle and Coinbase? And do you think this sort of was a deliberate move?
I mean, I think it's important to specify how the stable coins are used. So it's not enough to say big, but actually big in what sense? Like big how? Like big in what context? And I think if you look at some of these global stable coins, and as you mentioned, they're used globally, they're used in different parts of the world in the same way for the same purpose. That purpose is actually facilitating crypto trading to the largest extent, as far as I know. I mean, I think that's really the main kind of business case for stable coins. Idea being that you don't have to actually make payment transactions every time you sell crypto or buy crypto. You can just convert them into stable coins and then convert them back, so you don't actually have to make monetary payment transactions in between, which involves things like customer authentication and AML and so on. So if that's really the purpose, then I don't see a huge risk. I think if the purpose of stable coins is to facilitate trading on exchanges, they kind of are self-contained within those exchanges. And as long as they're not really used for other things like remittances or payments.
But they will be.
Well, I don't know. I mean,
like in certain parts of the world,
Maybe, yeah, but they will face a lot of competition. I mean, that's already a very mature market. I mean, they're of course welcome to come and compete in that area, but they will face a lot of competition. There's just simply not much business necessarily there, but maybe, yeah. And some of the rules, of course, are there exactly to manage those kinds of scenarios. If stablecoins become big also in other contexts, apart from how they became big now. So if they became big now as kind of casino chips in exchanges, what if they become big elsewhere as well? And then of course we need some of these extra kind of caveats in the regulation.
Okay, fair enough. So obviously here what the ECB and European Commission here are protecting the euro in terms of ensuring that there will be no, real threat or competition in relation to payments and remittances from other players in terms of the spirit of the
in a way,
regulation?
in a way, yes. Or at least they would have to then be on a level playing field with some of the other payment players and the other payment institutions, and kind of comply with a different set of rules, which is coming from the payments industry.
Fair enough. So reports on size, on usage, and then if you're becoming bigger and widely adopted more than central bank digital currencies or the euro or legal tender money, then you'll be flagged as a threat and possibly limited because of the threat you provide to the banking players.
Exactly. Yeah. They would become subject to oversight rules. So oversight referring to the kind of regulation that applies to payment systems, for example. So for now, they're not considered part of the oversight kind of field, but if they become genuine payment systems, then they would be
You're saying this
subject to oversight.
Big tension between the private market and private issuers versus the public players and central banks, and this tension is rising, and it's going to be interesting to see how it all unfolds. And if I could just a couple more questions. One is a bit long. I'd like to just sort of say the story of how Circle did launch a euro-backed stablecoin, but not as one would expect. So just for context, during last summer, 2022, Circle, Coinbase, launched a euro-backed stablecoin called EUROC. They, however, chose to launch their stablecoin from the US and hold their clients' funds with a US bank called Silvergate. This because when they launched their stablecoin, the Eurozone was undergoing negative interest rates. So if MiCA was scheduled to enter into force, the Eurozone and the Eurozone remained in negative interest rates, Circle would have lost money. This obviously since ARTs and EMTs would need to safeguard clients' funds by segregating them with a credit institution based in the EU. So at the time of holding clients' funds, MDs were sitting in an EU bank bearing negative interest rates. They would be unprofitable, and the bigger they grew as a business, the more they would lose money. Many have also opined that big companies may start to engage in smart structuring, such as incorporating a subsidiary in the UK or Switzerland to manage payments and to be able to use USDC or EUROC to be able to circumvent MiCA due to the unfriendly nature towards stablecoins. But this obviously would hamper innovation and also exclude European citizens. So what are your sentiments on all this? And do you think such large players would still opt to get authorized under MiCA with this heavy regulatory sort of environment which was created and is a bit putting off from an issuer's perspective?
Yeah, maybe MiCA might seem a little bit overwhelming. At first glance, but I think the idea behind it was to bring clear rules to Europe, and probably European lawmakers wanted to use the regulation basically to create a more friendly environment and to invite companies to do business in Europe. That's probably what the goal was. So the thinking maybe was that it's better to have strict but clear rules rather than no rules at all. But the problem of how to make money out of stablecoins or e-money, that's a well-known old problem. As I mentioned before, it's a well-known problem already for e-money issuers, and that's why we probably don't see that many e-money issuers in Europe. They quickly become credit institutions usually once they grow big. It might be the same thing here. I mean, there are certain licenses you can get, under MiCA, but once you become really big, and maybe you already have a credit institution license, then you could do all of the same stuff under a credit institution license, and that would have other benefits in terms of your financing, for example. Of course, there's more heavy, reporting. There's more supervision and so on. But right now, it looks like in Europe we'll have a very broad set of different licenses and different operating models that the regulators are offering to companies. You can be an ART or an EMT or an EMD or both, or a credit institution, or it tries to cover every possible scenario. But we've seen from e-money that in the end, many of the players actually just choose a credit institution license and do a lot of business under that license. And it might be that some of these different scenarios are, they will not necessarily ever materialize, at least in the scale that's been, that some of the lawmakers thought they would.
Yes, that is the the question, the unknown, to see who is going to get authorized, if these restrictions will put them off, if there will be smart structuring, if they will decide to comply in the end to service the European market, if these RTSs will address all these ambiguous provisions, which everyone's scrambling to understand. So which definitely is going to be an interesting few months. The vote is said to take place in April, unless it's postponed for the third time. Just as a closing question, how long do you think that the ECB will take to launch their CBDC? And do you think that the outcome will be that CBDCs and stablecoins will live happily in symbiosis? Or do you think these provisions were put in place to restrict stablecoins for CBDCs to catch up?
Yeah, so in terms of the timeline for the European CBDC, well, I'm on that project myself, so okay. I do know about the timeline. So there's an investigation phase now, which is ending in September this year, and then the ECB or the governing council might decide to continue with another project, basically the second stage of that undertaking, which would be called the realization phase, and that might take another 3 years, maybe. And even then, that would mean that there would be a technical solution, but it wouldn't mean that it would ever be used. So it would still need another decision, or whether to actually launch the product, whether actually to go to market. So I would say the earliest we could see a digital euro would be in 4 years, maybe 5 years is more realistic. 5 years. Could be even longer, yeah.
And also the implementation, because many member states sort of are very cash-based still, or the infrastructure won't be in place. If you look at Sweden or Finland, it's very cashless. Open banking is a thing. If you go to Cyprus, Malta, checks are still a thing and cash is still used. So even the implementation and rolling out of a CBDC seems like a massive operational and technical challenge.
Yeah, especially because it has to be rolled out in every Eurozone country simultaneously. And we've seen that some commercial entities have tried to do that, payment institutions, banks. It's incredibly difficult and takes a lot of time to build a pan-European payment solution. But to the question of will CBDCs and stablecoins live happily in symbiosis, I think probably yes, in the sense that I think, in my mind, they really serve a different market. So I think at least in Europe, the way we designed payment system or payment service, like you could use it to pay in a supermarket, or you can use it to pay online, a web shop or something like that. Whereas I think stablecoins, I mean, I know that people, they are thinking of other use cases for stablecoins, like remittances and international payments and so on. But I think still the majority of stablecoins is really serving the kind of the crypto trading market. And my guess is that it will kind of stay that way. That's really the core business of stablecoins. Whereas for CBDCs, it's more in the more traditional retail payment market. In that sense, I think they serve different customers in different use cases and will live happily, in their own contexts.
Yes, exactly. People have different risk appetite. So it could be you have some adoption with some merchants who want to service the crypto community, but many will still remain very risk averse. And also depends on the infrastructure of the jurisdiction that you're operating in. So I think that there's definitely room for both. Okay, so that was a really, really great conversation and discussion. I put some technical questions out there, and I think you did really well in trying to address them. Just before I let you go, I'd just like to invite you for a round of I Call Bullshit. I'm just going to read out a statement and let me know if you think it's bullshit or not. So the current market cap of euro-backed stablecoins currently in circulation, according to CoinGecko, is 3 billion. Do you think that figure is accurate or not?
3 billion sounds plausible. It sounds plausible. I know that there's about 20 billion of e-money in Europe, which is not a lot. 3 billion in that context sounds plausible, I think.
Okay, so it's actually bullshit. The figure is 450 million, so it's less, 500 million. And the top three stable coins consist of Euro Tether, Stasis Euro, and EUROC, so USDC Euro. I'm not sure the current global market cap of stable coins. It could be definitely in the billions, like in terms of the USD ones, but I think the Euro ones are like 5% of the total stablecoin market. So
right,
I don't think after these restrictions it's going to change drastically as well. Okay, so thank you so much, honestly, for joining such a great discussion. Really excited to release this. And for you, the listener, thank you for tuning in. If you enjoyed this episode, please like and share our show, and also subscribe to our newsletter. We will be launching our next episode of the mini series on the DLT pilot regime, so stay tuned. Thank you for listening.